Hello everyone, my name is Blaine Pearson and I am an instructor in Texas Tech's Personal Financial Planning program. In this video, we're going to pick up where we left off in part 2 of an introduction in portfolio management. In part 1 and part 2 of this video series, we covered how to arrive at the percentage of the total portfolio for a client and how to arrive at the capital gains and percentage gains for a client in Excel. We also reviewed how to arrive at the total capital gains for a client. In this video, we're going to take a look at the concept of global portfolio management and how we can use Excel to arrive at a global portfolio. First, I'm going to start a new sheet. I'm going to call this sheet Global. I'm then going to import. Now that I have a sheet and one combined sheet, I can then look at the concept of global portfolio management. What I mean when I say global portfolio management is the construction of one portfolio while taking advantage of the tax incentives of various portfolios. If I wanted to reconstruct my portfolio, I could put my equities inside of the 401k. Because of the tax incentives of 401ks, moving equities inside of the 401k can be advantageous. For example, we expect equities to outperform bonds. So if equities are inside of the 401k, we can then have those equities grow tax-free. We can then make changes to our equities inside of the 401k without incurring any intermediate capital gains or losses. We can then allocate our taxable account to include the majority bonds. As we saw in part 1, this client has a moderate risk tolerance. So let's assume she wants a 60-40 portfolio. For the remainder of this video, I'm going to assume that she has sold all of the positions in her taxable account and her 401k. This is how her two portfolios would look if she sold all of her positions. There would be $500,000 in cash and $200,000 in cash in her 401k. We're going to assume that she pays her capital gains taxes from another source. Let's now build our client's 60-40 global portfolio. So we'll add her 401k and her taxable account in developing this global portfolio. We can now construct the positions in her portfolio. Because she wants to construct a 60-40 portfolio, she wants to have 60% of her entire portfolio in equities and 40% of her entire portfolio in bonds. So we can use the equals 0.6 and times by the summation of her taxable account and her 401k account. So 60% of her entire portfolio is $420,000. She only has $200,000 in her 401k. So we know that she can purchase $200,000 in her 401k in equities. The remaining $220,000 will be used to purchase equities, but only in her taxable account. Because we know that the summation of her portfolio is $700,000, the rest will go to bonds in her taxable account. So we can hit equals the total amount minus the equity amount in her taxable account and minus the 401k amount. This will tell us that she will need $280,000 worth of bonds to achieve a 60/40 portfolio. Now we have a global portfolio where out of her equities, about 50% are allocated in the 401k where they can grow tax-free. Again, this is Blaine Pearson, and in this video, we covered the last part of an introduction to Excel and portfolio management.